Welcome to this video. This video is brought to you by Ecoholics. In this video we'll discuss about investment demand. This is the part of aggregate demand given by the famous economist, the modern economist, John Maynard Keynes. So here the name of the economist. So J.M. Keynes gave the concept of aggregate demand. So this is aggregate demand. Consists of two types of demand, consumption demand and investment demand. So here in this video we'll discuss about investment demand. So here in the formula version we are writing aggregate demand is equal to consumption demand plus investment demand. So now we understand the word investment. So the word investment means the net addition in the existing stock of capital. Now the word is existing stock of capital. Here we are only considering physical capital, not the financial capital. Financial capital are like, for example, debenture and share. But here in the physical capital we are just dealing with tools, machinery, etc. So this is the net addition to the existing stock of physical capital. So now we need to understand the what. So here we can consider about investment. So the real investment, that is net addition to the existing stock of capital. Here I am writing net addition This is the exact definition of investment. So now what happened? The real investment. Real investment does not include the replacement cost of capital. So here we are considering if your investment is up, it means it will further lead to increase in the aggregate demand. So aggregate demand in the economy will lead to further increase in the level of income and finally increase in the level of employment. Finally increase in the level of employment is the last and the utmost goal of this investment. Now we consider three types of investment. So there are three types of investment, we can say this. First one is business fixed investment. Second one is residential investment. And the third one is inventory investment. So here one by one we'll discuss these three. So the business fixed investment means the investment by the business person, the corporates, to produce the further production. Like for example, in order to produce consumer goods, we need to invest in the capital goods. So all the investment by the investors, corporate and the private investor will consider in this head. Residential investment means the investment by housing dwellers in urban and rural areas. So residential investment just for the housing purpose. Now the most important, that is inventory investment. Now what's the meaning of inventory? Why we maintain inventory? So the purpose to maintain inventory is to smoothen the level of production. In order to avoid the running out of stock situation, that is why we invest in inventories. So inventory sometimes as big as the factory total or as well as the retail shop. So that is why just to smoothen the process of demand and supply in the market, we invest much amount in inventory. So these are three types of investment. Now moving forward, we'll understand the two most important part like types of investment. Here types of investment. We are dealing with two types. Autonomous investment and the second one is induced investment. So induced investment. Now understanding the difference between these two is the most vital part of this video. This is the most important concept given by John Maynard Keynes. Here autonomous investment we are considering first, and then we consider induced demand. In autonomous investment is depend on the level of production. It means, for example, we consider the autonomous investment depend on the population growth, technological progress, but it does not depend on the changes in the level of income. So here the point is that autonomous investment does not belong to the change in the level of income. If autonomous investment changes, it doesn't mean it is affected by the changes in the level of income. So here we can write not affected by changes in the income level. So here it is not affected by the changes in the level of income. So here we consider one example about, like for example, if the economy is suffering from recession or depression, then the government come forward and then invested in the economy, because at the time of recession private investors became pessimistic about the investment and the future prospective yield. So that is why when the level of income is below the potential level of output, now the government steps in the economy and invested heavily in order to boost the aggregate demand. So this causes by the fluctuations in the business cycle. That is why the autonomous investment is not driven by the changes in the level of income. Now what happens? Now what are the two factors which autonomous demand depends upon? So that is the population growth, because government invested in the infrastructure depends on the population growth. Like we need more housing if the population is more infrastructure like road, port, airport, railway station, etc. We need more energy. If our population is more, we need more energy. That is why the autonomous investment should be come from government side. Considering about the another thing is technological progress. If the technological progress is progressing, like for example in 21st century there were so many telecom companies, internet service provider are in the market. That is why initially government invested in the IT sector and then the private sector step in later after maybe 5-10 years depending on the particular industry. So here we see the one graph actually about autonomous investment. So here the level of income, here we can write investment. So on the x-axis there is investment, on the y-axis we are taking level of income. So this is autonomous investment. Here the autonomous investment means if the level of income changes, it does not affect the level of investment. That is why the graph or the curve that is of autonomous investment is flat or full elastic. Now we talk about the another thing, that is induced investment. So first of all, it depends on the level of income. So we write it depends on the level of income. Now for example, induced investment generally by the private sector. So if we consider about this induced investment, it means if the income level increasing, then the investment will also increase. So now we consider one example taking about Indian economy. We are all aware that India introduced reforms in the year 1991. So after the reform process, there were a lot of private investment step in the market. But what happened before 1990? The economy was suffering from balance of payment crisis. So that is why the government actually cured the economy in 1991 and then made the policy which was actually investor friendly. That is why private investor invested after the reform process. Again, the same situation if we talk about world economy. After 2008 subprime crisis, private investors were pessimistic. That is why after 2011 and 2012, the private investors step in the economy. The same situation is going on in India also. If we consider example of our economy, the induced investment is very low at this level because of two major changes in the policy by the government of India. First one was the demonetization shock. So demonetization broke the trust of the government, trust of the people towards the government. Because if we consider the private sector needs the ease of doing business. If we consider about some dramatic changes in the policy, private investor will become pessimistic. The second reason is the de-stocking before the implementation of GST. So in the month of June, there were a lot of de-stocking by the producer and the seller. That is why the growth in the industrial sector went very low. That is why in order to increase the investment in the near future, government is making policy like reducing interest rate, etc. So that is why the main reason that private investors need a business friendly environment to induce investment. Now we consider about this thing. Here again on x-axis we are taking investment, on the y-axis that is a level of income. This is the curve of induced investment. So we are writing ID as induced investment. It means when the level of income has increased, your investment will also go in the upward direction. So these are the two examples. Now one important point which left in the induced investment is that the principle of acceleration. This induced investment working with the principle of accelerator. Now we have seen in the previous video about the theory of multiplier. The principle of acceleration is just opposite of it. The principle of acceleration says whatever the initial increase in the level of income which led to the multiple fold increase in the level of investment. So the induced investment we are get to know about the acceleration principle. Now we consider three important terms like marginal efficiency of capital, rate of interest and supply price of capital. We will discuss these three terms given by John Maynard Keynes. MEC, rate of interest and supply price. Here the first one is the most important, marginal efficiency of capital. Now we understand what is the meaning of this. According to John Maynard Keynes, it is the capital that we expect in the future return. So for example, if we consider the initial investment, there was some prospective yield 5 years and 10 years down the line. It means the future expectation of profit is known as marginal efficiency of capital. So future expectation of profit is means how efficient your capital is, the most important part of the interpretation of this term. Marginal efficiency of capital. Now the second one is a rate of interest. Rate of interest considered as the one of the most important part when we consider investment. Because if the rate of interest is high, the investor will not induced to invest in the economy. Interest rate should be very friendly for the investor. That is why rate of interest will be very friendly. Now we consider about one graph. Suppose here we are taking a rate of interest. Here this is investment demand. Here that is investment we are taking. So rate of interest we are representing with R, or we should represent with I, and here investment. So suppose for example investment demand curve is negatively sloped. For example, why it is negatively sloped? Because investment demand is inversely proportional to the rate of interest. Now considering the rate of interest, if the rate of interest is 5%, so we consider 5% as the rate of interest in our example, investment will be this much. Suppose this is 500 crores. So 500 crore investment with the 5% of interest rate. Now if we consider the same thing, that is if the interest rate goes up in the near future, suppose 6%, so the investment will come down. We can say that this is around 400 crore. So investment 1, I1 is the 400 crore. So this shows the inverse relationship between the rate of interest and the investment. Consider the third case. If the rate of interest is 4%, your investment will increase. So I2, this is 600 crore. So this is the proof that investment and the rate of interest are inversely related. Now we'll understand with the concept of rate of interest with the example of current Indian economy's perspective. Now if we consider about the policy of demonetization, the demonetization shock implemented in November 2016. After demonetization, there were a lot of surplus cash in the economy or in the bank. So whatever the deposited with the bank having surplus amount of cash, then the saving rates went down. It means the rate of borrowing has been very friendly. Rate of borrowing means whatever you are borrowing for the investment purpose. If we talk about this rate of interest, now the saving rate is around 3.5%. It means when bank have a lot of surplus cash, they will give it at a cheaper rate. So the loanable availability of the loanable funds is very easy at the time of lot of deposits. So rate of interest as went down in the recent months. Now the investment is very friendly for the Indian economy. Now the third one is supply price. It means the producer purchases the asset at the price which we call supply price. So the purchasing price of an asset is known as supply price. These three important terms we need to understand, that's very important. Now we consider the last part of this topic, that is factors causing shifts in investment demand. So first one, changes in marginal efficiency of capital. Second one is changes or fluctuation in demand. Changes in the demand of product. Third one is technological enhancement. And the fourth one is user cost of capital. Now we'll understand and I will explain one by one all these things. Changes in the marginal efficiency of capital. Now the marginal efficiency of capital is the future expectation rate of profit. Now sometimes businessman behaves like driven by the wave of optimism and the pessimism. It means sometimes they expect a lot of profit and sometimes they will not. So that is why Keynes gave the term known as animal spirits of the investors. So that is why the changes in the MEC is caused by the fluctuation in the pessimism and optimism of the business person. Now the second point is changes in the demand of the product. This is the very important point in the modern economy. All of the economy is driven by the demand of the product. So the demand of the product should be remain in the economy. So if the demand of the product is less, then investment curve will shift leftward because of the less investment in that product. Simple enough. The third one is technological enhancement. If some new technology innovation happened, like for example at the turn of 21st century, we invented a smartphone and mobile phones. So that is why a lot of investment went towards the smartphone manufacturing industry. So technological enhancement led to the shift in the investment demand curve. So in the telecom industry, investment demand curve is going rightward or shifting rightwards. The simple investment demand curve, this is, will go outward if the investment will increase. Now the last and the fourth one is user cost of capital. Now understanding user cost of capital should be reduced. Like for example, if we consider user cost of capital means the rate of interest. Rate of interest, and after that we consider corporate income tax is also less in order to invest more. So if the user cost of capital will be less, then it is beneficial for the investment demand curve. That's all for this video. Hope you like this video. If you have any doubt, any recommendation or any feedback, you can mention in the comment box. Or if you want any other video or any other topic to be covered in this series of these videos, you can also mention in the comment box. Please like this video, give a one thumbs up, and also subscribe our channel Ecoholics. This video will share with your friends also, so it will help you and help other students also. Once again, thank you so much. Have a nice